Hey, this is Josh. Today is Wednesday, July 19th. Today opened with a big gap down. Prices were always in short, strong bear breakout. Um, Prices were in a small trading range on the open. I came in somewhere around in one of these bars, I think during this bar. Prices had formed a small wedge bottom, likely to lead to two legs up. This was potentially the second leg up. I considered selling above this bar as a weak high one at the top of a trading range, possible into a bear trend line, but thinking that there was going to be a second leg up, I did not. Prices sold off above that bar for temporarily. This was a weaker sell setup on a stop below here. Um, Quickly became an outside bull bar. Bulls attempted to break out above the trading range. I forgot to mention this is a bear flag trading range, so likely to result in bear trend continuation rather than a reversal. um, this would have been a weak buy entry up at the top of this trading range, so better to look to wait to sell a failed breakout or sell this close or above the weak high one. Plan on scaling in if needed. Um, Prices formed a low two sell setup here with this big bear reversal bar. You could argue this was the small second leg up from here. So first leg pullback, small second leg up. And a trading range is pretty common for the second leg to fail and trap traders. So not a bad sell setup below here. Probably high enough probability for a scalp. However, this bull bar, when prices didn't sell off strongly below the bear bar, the bull bar decreased the probability. Okay to take for a swing short, questionable if it's high enough for a scalp. And you can see prices didn't go very far before they reversed back up to above the high. So temporarily found buying at the EMA. Small two-leg pullback. This is probably the second leg up from here, if not here. Big two-bar reversal. This is also a small expanding triangle. So reasonable two-bar failed bull breakout, two-bar reversal. Good sell entry below here. Expecting a test lower of the trading range. Prices big bear entry bar tested this, filled this bull breakout gap. But however, the follow through was not all that great. Formed a micro double bottom and a bull reversal bar. You can argue this is a high two buy setup, first entry, second entry. If I had sold over here, I held short through this rally. I did not expect prices to break above here, and if they did, I would have scaled in for a reversal back down since it's a bear flag trading range. However, the bulls did get follow through, entry bar and follow through. Bulls bought below this week low one. I don't think I made a scalper's profit. Yeah, did not make a scalper's profit buying below here. Not an unreasonable thing to do. However, you're in the middle of a trading range, so you need to be willing to scale in if you're going to take that entry. Looked like during that time, the bottom of the trading range was here. Prices had not quite made it down here. This is why I expected more down before reversal back up. So this was a bit of a surprise, but it was most likely due to these bulls scaling in, which these bulls scaled in here, exited, and then these bulls again scaled in 10 pips lower, tried to exit, could not reach the close, and that's probably what contributed to the strong sell-off. So you had a low one, weak, became an outside bull bar, poor bull follow through, not going very far. Retest of the bear trend line here. This is a low two sell setup off of the bear trend line. It's also a breakout pullback short to the middle of this expanding triangle. Not all that great of a signal bar, but okay to take for a swing short. Quickly reversed up, became an outside bear bar. May have trapped the weak bears or led to weak bears exiting. Strong bears sold more above this high and below here, so this was a better looking sell setup below here. It's a low two. with here and with here. So first entry, second entry, or first entry, second entry. The bear entry bar was not great. Became a bull reversal bar. The bulls tried for a failed low 2 and a bull breakout. However, the bulls did not get follow through. Bears sold above this as a weak high 1 at the top of a trading range, or a weak high 2. Became a big outside bear bar. Any bulls who bought on a stop above here thinking failed low 2 were trapped. Led to this strong bear breakout and sell off. Good bear outside bear bar, good bear follow through, back to always in short if you consider it always in long here. Came down, tested the bottom of this trading range. Bulls tried for a larger high 2 buy setup and failed bear breakout of the trading range. However, the bears sold to close and led to a bear breakout to a new low of the day over here. I forgot to mention this was a sell climax, likely to lead to 2 legs up. First leg up, second leg up. Turned into, this was a bear breakout with follow through. You can argue sell on this close. However, you're selling near the low of the day on a sideways day. If you expect a bear breakout and measured move down, you can consider taking it for a swing. Probably high enough probability for a scalp for a new low of the day. Another sell to close bar here. This bar ended the sell to close bar. It was also a failed breakout to the new low of the day. Quickly entered a tight trading range where the bears were taking profits. Bulls are buying below the previous low, scaling in lower. This was a weak low 1. You can consider buying below this bull bar. This can also be considered a sell climax. We had a bear breakout gap here. Arguably a breakout or measuring gap here, and this was more likely to become a exhaustion gap. So you can argue buying below here. However, that would be an aggressive thing to do. Most less aggressive traders would probably wait for a strong reversal up before looking to buy. But if you're willing to scale in, it's not an unreasonable thing to do. So the buy setup for the sell climax and reversal. Not all that great, sideways, reasonable swing, but did not trigger. Quickly sold off to a new low. However, the bears were unable to generate strong follow-through selling below here. Outside bear bar, prices ticked above here, which was a weak second entry for this entry. Not likely. It's a bear bar. You can consider taking it for a swing, but I personally wait for something higher probability. Quickly sold off to below the low, but the bears were unable to generate follow through. Reverse up on the next bar for a second entry for the first entry in the sell climax. Reasonable swing buy above here. You can consider this a small final flag reversal where the breakout failed. It's also a tight trading range at a new low of the day, so it suggests bears are taking profits and bulls are buying. Okay, swing buy above there. So poor bull entry bar. The bears tried for a failed high 2 and for a variant of a low 2 and to sell off the market. Could not trigger. Became a the bulls got a test above, but again closed weak down. Did not close as a bull follow through bar, and instead closed as a bear doji. But again, weak sell order at the bottom of a tight trading range. You can consider it a low 2 sell setup, first entry, second entry, or also a failed high 2, first entry, second entry. But again, you're selling at the low of the day on a mostly sideways day. So more likely buyers below, and that's exactly what happened. Bears exited, bulls bought. Almost became an outside bull bar. It's still a failed low 2 and a second entry for here or here. Reasonable to buy above here. Prices bulls got a good bull entry bar. Not great follow through. Still expected a second leg up from the final flag reversal and failed bear breakout. I honestly thought prices were going to come up and test the high of the trading range, or at least the bear trend line. But instead, prices reversed at the top of this sell climax. This was the first bull target for any bulls who bought down here. The next would have been a measured move up. sorry, I got cut off at 10 minutes. So the first bull target was reached, which was above this sell climax. This was a weak high one, but a second leg up was likely from the failed bear breakout and the final flag reversal. You can argue this is the second leg up or this is the second leg up. So weak high one, you can consider selling above here if you expect prices to reverse down, but you need to be willing to scale in if prices come up here. This is the middle of the trading range, so 50-50 probability. Instead, bull breakout above, bull follow through. However, the bulls exited at this high and formed the next bar formed an outside bear bar and a low 2 sell setup with here first entry, second entry. I honestly thought bars below this bar and prices were going to test higher. I was a bit surprised by the bear strength and this test back down. But what ended up happening is prices tested the middle of this tight trading range and led to a double bottom and higher low. And the bulls were unable to generate enough strength to break above here and formed a small wedge top. But so outside bear bar, bear entry, bear follow through, back to always in short. This is a weak low one near the low of a trading range, but you need to be willing to scale in. If it was down here, I would say definitely acceptable scalp, but up here it's a little riskier. So did not find buyers immediately, sold off into a small second leg down where prices formed a double bottom and the bears who had sold down here were able to get out and exited, contributed to this small rally. This was a big bull bar, double bottom with here, but pretty strong selling. Not first entry, not all that great. Okay, swing buy, probably better to wait. Became a bears attempted for a failed reversal, but instead became a double bottom pullback. So double bottom pullback. Also second entry for here. Reasonable to take this for a scalp or a swing, expecting prices to test up to here. Good bull entry bar, good bull follow through, always in long. However, prices just have entered this tight trading range since then. This was a weak high one. You can argue it's to the top of a bear flag, but second leg up. I was expecting a second leg up from here. So prices came back down, filled the bull breakout gap, tested the bull entry, found more buyers. The bears tried for a larger low 2, so here's a low 2, and then you also have this one, first entry, second entry. It's also a failed high 2, but I was expecting a failed low 2 and a strong bull breakout. However, and I expected that to occur here, but the bulls just were not able to get follow through above this high, and you can see lots of selling pressure in here, and prices formed a small bull channel, which is probably the second leg up from here, or arguably spike, small channel, 1, 2, 3 pushes up, and a small wedge top, failed bull breakout. However, it's a bull signal bar, so not all that great, and you're selling near the low of a trading range, so best to take is a swing trade. And since then, so pretty much the whole day stayed in a 20 pip trading range. There's a possible trend into the close for maybe a bear trend resumption day. I don't expect the bulls to generate a strong rally and a buy the close bull trend, so I think that if the daily range doubles, it will probably be to the downside. There are some bear targets down here, especially down below this bull breakout and buy climax. So there are bear targets below, and if you look at a 1 or a 4 hour chart, the prices were in a strong sell the close bear trend overnight, tested below this buy climax, and it's temporarily found support, but I question if prices won't make it back down to here, possibly test the middle of this trading range. So pretty slow day, not all that great, not a lot of movement, a few good entries, but mostly limit order market, pretty boring trading in here, pretty hard to make money in here. That's about it for the day. I do have some questions from another trader that I'm going to go over now. Okay, first question. Will I answer questions related to the price action of the day that I analyzed of the EURUSD? Or will I also answer questions with price action that I have studied? I will answer any question regarding trading. Doesn't matter if it's I would not want to answer questions directly about another market just because this is the only market that I'm currently trading. But I will answer questions around trade management, price action in general, basically anything about trading. But so no, I will not limit questions to just my analysis of the day. Second question, what stop loss do I apply in my day trading? We know there are two types, swing stop and a scalp stop. I am a scalper, so about 6 months ago, I only used a 10 pip stop and a 10 pip profit target. Since then, that was back when I was using FXCM. So and 10 pip moves were a lot more common back then. Nowadays, fast forward to a year later, nowadays, especially with the spread, 10 pips are less common and harder to come by. But personally, I use a 20 pip stop. I talked with another trader who I used to talk to semi-regularly back then whenever I was trading I used to advocate for a 10 pip stop and 10 pip profit target. So I talked to him recently, and he said he's still using that and he's loving it. However, I personally use a 20 pip stop to allow prices to go against me, and if I want to consider scaling in, I will. And it also helps alleviate the issues with the spread because I got tired of getting stopped out at 10 pips only to watch prices go directly where I had expected. So personally, I use a wide stop. I have been trying to swing more lately, but it has not worked out well for me. I will most likely just focus on scalping from now on and not try swing trading anymore, just because I can't handle the the low winning percentage, and I prefer entering high probability setups. And you cannot enter high probability setups and expect a large reward. So I personally use a 20 pip stop and usually take profits around 10 pips, unless there are 4 swing trades that I will take, and during those swing trades I hold for 2 legs or 20 pips, so I would use a 20 pip stop and 20 pip target. I've talked about those entries before. I can discuss them later, but I've got more questions to get through, so I'll save that for later. So next question: for a swing stop against a trend, how would you recommend a stop loss, or even better, if you're in a trading range, how would you situate your stop loss? So a swing stop against the trend, that is not a good thing to do. So a swing stop is a stop used when you're in a trend and you're trading with trend. So that's counterintuitive. So if you are trading against the trend, you need to be using a tight stop like a 10 pip stop or above the signal bar, which I would say minimum of 10 pips. So if it's a really weak channel, you can argue selling, buying low, selling high. It's scaling in, since a weak channel is very similar to a trading range that is slanted. So if it's like a day like today, you could argue buying lows and scaling in since it's a weak bear channel. But in general, that would probably create bad habits, and for the most part, I would say if you're trading counter trend, you're most likely taking a reversal trade, and since the probability is against you, you need to exit quickly and not rely on a wide stop like a swing stop. If you were in a trading range, how would you situate your stop loss? Again, several different. The stop loss is really dependent on of your style of trading. So if you're an always-in trader, you're going to be using a pretty wide stop, like below the breakout or below the spike. and you're holding for a reward of at least equal to your risk. If you're a swing trader, you're either using a swing stop, trading with trend, or you're using a tight stop like 10 pips beyond the signal bar. If you're a scalper, you are most likely using a wide stop with the intentions of scaling in. However, that is not completely necessary, which I'll address later because he has a similar question on that. So as far as how would I recommend a stop loss, it largely depends on your style of trading, and it's a very personal thing to deal with. I would say a minimum of 10 pip stop. If you use anything tighter than that, you're going to die a slow death of a million paper cuts. So 10 pip stop minimum. If I was trading in a trading range, if it was a failed breakout and I'm expecting two legs in the opposite direction, I would use a 10 pip stop beyond the signal bar. However, if it's a trading range and I'm just maybe buying a weak low one at the bottom of a trading range, I would consider using a stop based on a measured move based on the height of the trading range, or what I always do is just use a 20 pip stop. So what I do may or may not work for you, and it's all, trading is a very personal journey, so like I said, largely depends on your style of trading. Okay, so in the case of using a swing stop, it doesn't mean that you have to wait for the price to reach that stop loss. We know there are several, but maybe there are some that we missed. 3 consecutive. So basically he's asking when would you exit if you're using a wide stop. So he's saying 3 consecutive bars against you, a breakout plus follow through, which definitely both of those, if there's a breakout and follow through against you, you need to get out. I personally tend to hold on too long sometimes. So my newest thing is basically if prices do not do what I expect them to do, I'm getting out. Either break even, small profit, small loss. I don't care. I will, if prices are not doing what I expected them to do, I'm getting out. Basically, if you're disappointed, then you should probably exit and look for another entry. Okay, in the case of using limit orders to enter the market, how would you place a stop loss? And if in the case of a swing is clear, in the case of a swing it's clear, okay, but in the case of a scalp question, a number of pips question. Okay, so when it doesn't matter, okay? So if you're entering with a limit order or a stop order, it probably doesn't matter. You're going to use the same stop that you use on a normal basis. So however, if you're using a limit order, you're probably some type of scalper, less likely a swing trader. So you're probably willing to scale in. So if you're using a limit order, I would say you're more likely to use a wide stop. But that's not necessary. So like I said a year ago, I used a 10 pip stop and a 10 pip target, and I had success with that. So it does not matter if you're using a limit order or stop order, you're probably going to use the same stop either way. But I will say, if I'm entering on a stop order, I try to hold for a swing target, and that's just because, which I'll address in another question in a minute. The probability of reaching a scalper's profit, at least in my experience, is lower. So if I'm entering on a stop, okay, I mean counter trend though. So if you're entering with trend on a stop, you can probably scalp and have a high enough probability. But if you're taking a reversal trade, so a major trend reversal, a failed breakout of a trading range, and you're entering counter trend, expecting a new trend to form. So in that case, if you're entering on a stop beyond the signal bar, I would say you need to be taking it for a swing trade. I hope that answers the question. Okay, many times when you scalp, one has to scale in so the probability of making money is greater. What do I focus on? This is true, but it's not necessary to scale in. I personally don't always scale in. I try to avoid scaling in whenever I can. I honestly don't like scaling in, and like I said before, I used to only use a 10 pip stop, and I did not scale in at all during those. Sorry, cut off again. So yeah, I prefer not to scale in, but I will consider it depending on the price action and depending on the day. So I try to avoid it, and if I don't think that prices are going to reverse after going 10 pips against me, I will just exit. So, okay, the last question, or second to last question. The markets, especially markets like EURUSD, volatility changes quite a lot throughout the day. It is common that price doesn't reach the minimum distance of a scalp, 10 pips. Yes, this is something that I have talked about on the forum recently. So a year ago, like I said, when I started trading the Euro USD, 10 pips, 10 pip movement, 10 pip moves were common. So it was obvious that the institutions were scaling in at 10 pips. They were taking profits at 10 pips. They were scalping for 10 pips. Fast forward to today, and that is not common. So what I mentioned in a post recently was that I have watched the institutions, they scalp for 5 to 7 pips nowadays. So I am convinced this is due to the spread because I was using FXCM back then and I did not have to deal with the spread. They were charging a commission. Long story short, if you are trading with a broker, which you have to use a broker with a spread nowadays. So I'm convinced that now they are scalping for 5 to 7 pips, or it could be due to the spread, which is affecting the price action. So my theory is that as the institutions switch to the 6E, which the 6E, it's obvious that the institutions scalp for 10 ticks, which is 5 pips in the Euro USD. So I am convinced that as institutions focus more on the 6E than the Euro USD, that the Euro USD will eventually follow the 6E rather than the 6E following the Euro USD. However, I have no way of proving that theory, and I have never worked with an institution, so I could be completely wrong on that. That's just my theory. But yes, it is very aggravating, and it is very common for prices not to go 10 pips and not to fill your 10 pip profit target, especially when entering on a stop order. And that is why I recommend, if you're entering on a stop order, I recommend swing trading. Limit orders do tend to reach 10 pips. However, sometimes they don't either. So you either have to take a smaller profit or hold with a either tighten stop, break even stop, or rely on your original stop and hope for the best, or exit if your premise changes. So yeah, I feel your pain, and I have dealt with that issue myself. And unfortunately, there's no easy way around it unless you're willing to trade the 6E, in which case you could scalp for 10 ticks. I would not recommend trying to scalp the Euro USD for less than 10 pips. You could argue trying to scalp for 5 to 7 pips in the afternoons, but you're probably going to lead to a negative trader's equation if you continue doing that too long. So how do you think we could anticipate such volatility in an indicator like ATR? I have no idea what an ATR indicator is, and I would say definitely do not rely on any indicator to tell you what is happening or what's potentially going to happen. The only thing you can do is know when a news announcement is coming out, which is usually what leads to the big moves and volatile moves. So a lot of times around 8:30 a.m. Eastern Standard Time, there's a news announcement. And just be aware of all other news announcements, because that's generally what causes the big moves that end up wiping you out. So I would not recommend using any indicator to try to identify that in advance. Just mainly focus on the price action and do the best that you can at mimicking the institutions. And you have to understand that we can't mimic the institutions completely, right? Like, unless you have really deep pockets and you're willing to hold with a huge stop, you can't trade as an institution. The only thing that we can do as traders is identify turning points where there is a mathematical edge that provides a strong trader's equation. So the best thing to do is just try to identify the type of day, how the institutions are trading, and then wait for a strong setup that aligns with that. So I hope that answers all the questions, and if anybody else has any questions, feel free to leave them below. I probably will not check messages on the forum, so it's best to leave questions below, or you can email me if you have my email address. All right, that's about it for today. See you tomorrow.